Now we just go to some fundamental principles of measurement. How do you record fair values? The thumb rule is, I'll just get into that. The thumb rule is all assets, liabilities, whether identified in the balance sheet or which are sitting as intangibles, not identified in the balance sheets, need to be fair valued. So you have to dig out for liability. See, what happens is, what is goodwill? Goodwill is nothing but a residuary of intangibles. So the moment you say I have acquired, there is a fixed asset sitting in the books, there are other current assets, there are other current liabilities. All this I have acquired, but I'm still paying him much more. Why? There could be certain other intangibles which are not recorded in the books. For instance, customer contracts. That business will have significant customer contracts, but you don't record customer contracts in the books. So this becomes, and if it meets the definition of an intangible, then you record in the acquisition accounting customer contracts separately. You will attribute a value to that. Now similarly, you acquire a lot of things. You acquire the people also, right? You acquire the workforce. That is also what you're paying a price for. You're paying a price for everything. Now workforce we don't record. The question is, can you record? Does it meet the definition of an intangible? It does not, because you don't have control over that asset. It can leave any time. Hence, we let it subsume in goodwill. We don't split it to say workforce is a separate intangible. We let it remain in goodwill. So all those intangibles, hidden benefits that you are not able to record in the books because if it doesn't meet the definition of an intangible, get subsumed in goodwill, right? So customer contracts, we will separate and record as an intangible, but workforce will get subsumed in goodwill, right? So the principle is all assets, liabilities, whether identified, not identified in the balance sheet, search for it, evaluate intangible, then record it. Difference will be goodwill. Now there are certain exceptions, okay, to the thumb rule of fair valuation, and that is what we will try and cover in the next slide. So we said all assets, liabilities, I will record at fair values. Exceptions to this principle of recording on fair values and recording liabilities itself which do not meet definition of liabilities. So what the guidance says, again, is very, sometimes one can challenge this, but it's pretty debatable. It says even contingent liabilities, okay, the acquirer shall recognize, to your point on legal claims, you talked about claims, etc., right? The acquirer shall recognize at the acquisition date a contingent liability assumed in a business combination if it is a present obligation that arises from past events and its fair value can be measured reliably, right? So let's say you have a litigation, a case going on. Yes, it's a contingent liability. Do we record contingent liability in books? We don't. Disclosure. Now this is an exception. In a business combination, you will have to record this contingent liability on a fair value basis. So for instance, if you have a lawsuit coming of let's say 1,000 crores, you will have to make a probability assessment to say that, look, what is the estimate? Will it be 100, 200 or will be none? If I estimate 100, then I record a liability of 100 on the date of acquisition. What is the immediate next impact? Where does this impact? Goodwill. Immediately your goodwill goes up. The moment you add a liability, your goodwill goes up, right? So this is a very significant change. And again the same issue. If you don't end up paying this contingent liability that you have recorded, what happens? It goes to P&L. No adjustment to goodwill. At the same time, if you recorded 100 crores and you ended up paying 600 crores, the 500 crores will go to P&L, right? A very, very significant change, a very debatable. Do we see this logical?
No, but then you have to also reverse the contingent liability, right? What you have recognized.
The very first question is it logical to record contingent liabilities in the books?
No, once it is recorded, it's no longer a contingent liability.
Yeah, I think that's a good answer, but just getting to it where we got to, as in why did we record it? Do we record contingent liabilities? You don't, right? So is this logical? Debatable.
Yeah, we do see provision for
right?
contingencies in annual
But we are saying that uski surety,
then it is not contingent. Okay, so I think the other argument to this is, and why this would be brought in is to say, look, apparently it looks very illogical. Why do you record something which is called contingent liability in your books as liabilities? The argument is, see, when you are looking at a business, okay, when you are valuing a business, you are looking at it holistically. So let's say if you are evaluating two businesses of the same size, one business has 2,000 crores of contingent liability, the other business does not have. Will you pay the same price? Will you pay the same price for that both businesses? You will not. Why will you not pay the same price? Because of certain contingent liabilities which you potentially believe could be liabilities which will come in. So in your valuation assessment, you have already factored the pricing of this liability. The guidance is saying just bring it on the books. You know in your mind what is the value that you are estimating that these liabilities could be. You may say 0, you may say some value. So bring that value in your books. That is the rationale or the principle why they say even contingent liabilities in an acquisition you need to fair value and record in your books of accounts on the acquisition date. Again, very challenging, very very judgmental because this could be like a hidden reserve again. You create at a very high level. The P&L implication is straightforward. Sorry, go ahead.
In some case, if we are not recognizing as a contingent liability in our books, then it will capitalize the goodwill. So anyways, this is coming into books.
No. So that's a good point. So if you did not record contingent liabilities, then you have missed the bus. If you ended up paying later on, straight P&L.
That is okay. But
Sure.
as you are saying that it's a liability.
Correct.
And it is coming to books as it's a contingent liability, and we are not paying a same amount for both the businesses. Anyways, it is coming to goodwill.
No. So the point is, why are you recording this? The point is why you are recording is you may pay different values, right? What we are saying is why you are recording this because you are attributing some values in your projections. When you do a valuation, you are anyway valuing this, that this is approximately so much. So I will anyway bring it in my books.
Sam, just I am saying now, if we are recognizing as a liability, if we will not recognize as a liability, then we will recognize as a goodwill.
But it is possible that you may pay less for this. So your goodwill number anyway, when you do the allocations, you will pay less for your purchase. The purchase consideration may be lesser than what you would have normally paid, right? You will anyway have reduced your adjustments in that. So the logic is basically what we are trying to say is why you are bringing in this. Because you have certain values in your mind that these liabilities will have certain values, hence you are recording this as liabilities in your books. Sorry.
Here what we are saying is these liabilities should arise out of past events.
Yeah.
What about the liabilities which may come up because of this combination?
That you have to record. If there are certain liabilities that are coming as a part of acquisition accounting, anyway that has to.
Not from past events, but let us say there is business combination, and because of this business combination, some customers are willing to go to court.
Yeah.
Because they are opposing this combination.
So then is that a present obligation? Okay, there is a slight difference. Let's look at, just hold on to that. We have an example where we will cover this, past obligation versus present obligation. So that was one exception I wanted to cover. The second one is obviously income tax. You will follow the income tax standards.
I'm just on contingent liability, I'm just thinking on the disclosure part of it.
Right.
So like we have already recorded in our books, then how that disclosure will be done? So would
Yeah.
that be disclosure or
Now this has become a liability. So you will say that your liability is recorded on acquisition.
so to give the numbers, like I have contingent liability of 1 lakh rupees,
Right.
and I have assumed that 50,000 will be coming.
Correct.
Then difference 50,000 is there.
So you will record your assessment of the liability is 50,000. So you record 50,000. There's no further disclosure on contingent liabilities. What you will say is basically 50,000 is what recorded. Whatever you pay less minus, that will be a straight P&L adjustment because the liability you will debit of 100 and the 50 you will debit to P&L. So just hold on. We have an example on contingent. We'll talk about it more. Income taxes. You don't fair value income tax. You will record based on normal principles. There's no fair valuation of income taxes. Employee benefits, separate standard IS 19 actual benefit, gain loss. You look at it that way. Again, you don't fair value as required from business combination. And to your point, Mirza sir, the identification, indemnification assets. So, there are certain liabilities that you take over. The acquiree says that, look, you agree that, look, I'm taking over this, I'm going to pay on your behalf. So I want an assurance and indemnity. So he says, okay, to the extent of 25 million, if this liability fructifies, I will pay you. So I have an indemnification asset. So I am recording that asset at a 25 million because I am saying this is assured. I have recorded a liability of 25. I also recorded an asset of 25 because I am saying this is indemnified. I have a shareholder agreement with the person. he's going to pay me back. So I have a liability I have taken over. I have also taken over an asset, an indemnification asset. So you record an asset immediately because you have agreed with him that this amount he has to reimburse in case it dwells on you.
What if that is not the condition? The condition is you couldn't achieve a certain EBITDA multiple.
Right. But that
then
is...
you have to give me back $1 million, dollars, whatever.
No, so this will...
No, not a liability.
No. So again, just to be, was saying that if so when I do an acquisition, I am saying I am going to pay you more when the business is coming in, that is contingent consideration. But to your point, you are saying the acquirer is asking.
Acquirers say, if you achieve this EBITDA, none of us do anything. If you achieve a higher EBITDA, you will get an extra $1 million.
Which is what we...
If you achieve a lower EBITDA,
correct.
You have to give me back $1 million. What happens in the third?
So this is something very, we've not seen normally some of these things.
So
Yeah.
ideally, in my view, it will still be
It should be in an escrow account.
Yeah.
right. So the way it is, see, it is just that you paid in excess amount, okay, upfront, okay, to the person, and that person will really pay you back because what you did is with an expectation that a business will yield an X result. And if the EBITDA does not come based on the representation which he gave, he's supposed to give you back. It is still a contingent consideration which is really there. It's just a cash flow issue. In the first example which he gave, when you have to pay something extra later on, you are not paying an immediate cash to him, right? In that case, you will say it is you will still do the fair value of contingent consideration, recognition which is there. Anything more which you have paid than the fair value, probably in this particular case, will be an asset. Because what will come is, see, let's say I was supposed to pay you only 20 rupees, but I paid you 100 rupees. Okay, and this 20 eventually will become 100 if everything really goes off. Then this liability will get set off against this asset. But if in this particular, in your example, I've already paid you the amount which is really there. I'm not deferring that payout. Then I have a receivable. That receivable will really, but the way goodwill and everything will get calculated will be still based on fair value of the contingent consideration. The difference between the cash flows ideally either will be an asset or a liability. That's how it will be.
And where will that get reversed?
Sorry?
But, for example,
So normally what will happen
Yeah.
is if the EBITDA, see,
If
we
the
already
EBITDA-
factored it in the fair value, the thing which is supposed to be taken. Now let's take two scenarios. One first scenario, everything goes as per the expectation and things which is really there. Then this 100 rupees ideally will not come back to me. Okay, because, but then what I'm supposed to do is, let's say I'm just taking it and keeping it in an escrow account and thing, and I'm treating it that this 50, this contingent consideration will become 100 rupees. Then there's a liability which will come. This liability will get offset against this 100 rupees, right? So in that scenario, it is like you treat it as a two different transactions.
Start with the net amount actually.
Yeah.
And
Yeah.
this-
Exactly.
Correct.
So that's how it is working out.
Correct.
In the case where you get a refund back, the asset will really get realized automatically. So your goodwill calculation will always be a normal because it will be based on the fair value of the contingent consideration only. That's how it will work.
So when he's paying me back, we can't recognize it as an income.
No, it will not come because if you are realizing an asset, you will have an asset on your balance sheet which is getting realized in his example.
Okay. So indemnification asset, if he's indemnified you that if these liabilities come in, I will pay you X amount. So you record that liability and you record the indemnification asset to the extent of the liability. There is no fair valuation of the indemnification asset. That's the exception that we are talking about. There could be some reacquired rights. Sorry, go back. So what we are saying is, let's say there are certain sales tax disputes. So the acquirer is saying, okay, if this fructifies in future, I will reimburse you 25 million. So what I say is, I will record this liability at 25 million. If my fair value, he said whatever fructifies, I will reimburse back to you. So I will make an assessment that if the value is 25 million, the liability fair value I believe, then to that extent, I will also record an asset of 25 million. So I'm recording a 25 million liability. I'm also recording an asset because this I'm not going to pay. I'm going to recover for that person. That's an agreement that has been done. So what we are saying is this, the principle we have said is all assets liabilities fair value, right? But this indemnification asset we are not fair valuing. We are restricting it to the liability that is there because that is a linkage. So what it's saying is the indemnification asset could be based on actual number. It's not a fair valuation number. That's why we are saying this is an exception to the thumb rule that all assets liabilities have to be fair value. This will be based on what the agreement says. Right? Again, reacquired rights. So let's say you sold a patent or a trademark to the acquiree earlier. So he has recorded an intangible license in his book. Right? So now when you're acquiring back, it's a reacquired right. It's an intangible that is sitting in his books, which you are getting it back. Now what the guidance says is you only sold it to him. You sold a license. The license is standing there. It's a 6-year license. 2 years have gone. So it says you will record the license back in your books at fair value, ignoring potential renewal. So whatever is the balance 4 years utility of that license, at that value you will record the license, not at what it is standing today. You will just look at it, the license is valid now only for 4 years. What is the potential cash flow? And that is the value you will attribute. Not considering that, look, if this can be renewed, what would have been the value, etc. Because this is my license. So logically, I just need to do for the balance period pending, only that amount of cash flow, whatever comes in, is the intangible I am generating. I will not factor future renewals of the license. Again, an exception to the rule. Share-based payments, we said, is a separate standard dealing with it. So hence, it is, you don't just do fair value, you record based on the standard that is there. Assets held for sale. It says you will record, again the standard says you will record based on the separate standard 105, it says you record fair value less cost to sell. Again the exception to the rule that everything is fair value. This is not fair value, this is fair value less cost expected to sell for assets held for sale. These are some of the exceptions to the normal rule of fair valuations. We talked about this contingent liability, we said it's going to be fair value accounting. Again, this is just a reinforcement of the same. Okay, so Burger King sells burgers. Let's look at this example. Experience suggests that 1 in a million burger sold is contaminated. Burger was acquired by Pizza King, on which date Burger had sold 1 million burgers in the past week or so. Should Pizza King provide for the liability in the acquisition accounting that may arise in a contaminated burger? What do you think? Should we record a liability knowing fully well that one burger has an issue and there could be potential claims?
Yes.
Should record a contingent liability? All agree? No? Why?
I think when we are going to acquire any entity,
Yeah.
in the same day that entity must have that obligation, maybe a contingent obligation that it is exist on that day.
Okay.
So in the existence, then only I have to recognize in our books. If not, then I think we should not.
Okay, so he says that we should not because there's no obligation at this point of time. Any other thoughts?
But
Okay, all,
obligation could come, so that is
or obligation could come, right?
so that is why we record.
Okay, so let's see what it means. You're right, you don't record this because this is a possible obligation. Let's go back to the definition, what we said earlier. We said here, and if you see it's in bold, if it is a present obligation, if already certain claims had been launched, then it was a present obligation. But here, nothing has happened so far. No claims have come in, right? So there's no present obligation at this point of time. Hence, this is a possible, not a present obligation. Had somebody already sued him, then this could have become a contingent liability. But there's nothing has happened so far, it's going on as usual. That's the definition says. Differentiate between possible versus present. Yeah?
So it should be seen on acquisition date.
Sorry?
It should be seen on acquisition date or what?
It will be?
Seen on acquisition date? or
So you
what date?
don't record a liability on acquisition date. Whenever the liability crystallizes, in whichever period, it's like a normal liability you got. As you're running business, you got a liability, you record it.
In our earlier example, in a High Court case,
Yeah.
like we are starting the contract on 1st of January.
Yeah.
The High Court has given authority on 29th of March.
Correct.
The liability arises in between of that.
Correct.
What will happen in that?
So then that could be a problem area. Because the date of control, you had this liability. And the fair valuation happens, remember, on the date of control. Not in an earlier date. So on the date of control, when you acquired, if this was already a liability which had come, as a then it was a problem in those situations. Okay, we'll move ahead of this. We did indemnification assets. I will just skip this. Okay. Okay. In January 2010, entity P acquires a 100% interest in S, a manufacturer of cosmetics, at the time of acquisition, there are two open litigations. Litigation 1, S customers have alleged that S products contain harmful levels that cause breast cancer. The claimants are suing S for damages amounting to 50 million. Litigation 2, a dispute with tax authorities over its tax return for 2008. We will indemnify P for the losses up to 25 million. Okay, the acquiree V is indemnifying. In case litigation 1, P also has received an indemnification from V to cover the outcome of litigation 2. How should P account for the contingent liability and the indemnification assets, assuming that the fair value of the contingent liability resulting from litigation is 15 million. The outflow in relation to the litigation 2 is probable. The estimated amount expected to be paid is 13 million. The fair value of the liability is 11 million. So we have a contingent liability situation, we have a indemnification asset situation. So how will we account? Let's look at litigation 1. In the purchase price allocation, identifiable liability of 15 million is recognized. Why a 15 million is recognized? That's the fair value of the liability, correct? The liability is measured at fair value, the indemnification asset should be measured at fair value. So the indemnification comes equal to the liability. Asset is recognized amounting to 15 million, assuming that none of the possible outcomes taking into calculation of the fair value of liability exceeds the indemnification cap. Because he has indemnified us, right? In the first case, he said, S customer, the claimants are suing S, litigation, we will indemnify P for losses up to 25 in litigation 1. The moment we said it was 15 million, so you record an asset to 15 million, right? It has to be equal to the liability, the asset that you are creating. Litigation 2, in the purchase price allocation, liability related to litigation 2, tax litigation is recognized at 13 million. That is the amount expected to be paid, not at fair value. What is the amount that you are expecting to pay? This is the amount that you are saying is an outcome that is going to come. So 13 million. The indemnification asset has to be recognized and measured using assumptions consistent with those used to measure indemnified item. Hence, the asset also will be 13 million is recognized assuming no risk. So the point is the indemnification asset will always be determined by what the liability is and what is the amount you have been indemnified with.
So this indemnification, when you get the amount, it will go to the P&L.
No. So you recorded an asset, right, on acquisition, and you recorded a liability. So what happens? You paid the liability later on. So you, after 1 year, let's say that happened. So what will you do? You liability to payment. At the same time, you will say, I will also get this money. So cash bank to asset. So that's the way the liability and asset gets knocked off. You can just say liability and asset knock off, I will get the other guy to pay it. Or if he's already paid me, it's an escrow, I will actually pay the outflow, reduce my liability, remove the liability, and similarly the amount that I am getting from the other person will be credited to my asset. So asset credit, cash bank debit. So both gets knocked off. Right? Okay, moving on to another principle, just again so that we are aware.
But in cases, cases where it is like, in case of the consideration,
Contingent consideration.
wherein it was dependent on performance.
Right.
In that case, it goes to the P&L.
Yeah, so then that you don't record as a liability on day one. You're saying this is not a purchase consideration, activity. This is completely outside arrangement that you're doing. Because it is linked to performance, you're paying him salaries and bonuses. This is not got nothing to do with the business.
No,
or the purchase.
If it is a contingent consideration,
Correct.
if it has been identified as a contingent consideration and then it gets settled after say 2 years,
Right.
and then we receive some money.
No, but there is no indemnification for the contingent consideration, right?
Okay.
So no one's going to pay you. What is contingent is you're saying I'm going to pay you extra for the business. What here we are saying that if you are taking over a liability from the acquiree, let's say you're taking over a sales tax dispute which is happening. You're saying, look, I am not going to pay this, I want you to indemnify. That is where we are saying you have a liability and you also have an asset. What is the asset? He is going to pay me for this extra. I am not going to pay for this. I am going to recover and pay for this. So this is not my liability. I have taken over a liability, but I have also got an indemnification, a guarantee from him that if this devolves, I will pay you. Right? Okay, just moving on. NCI, which is nothing but your non-controlling interest. So let's say you acquired 80% and 20% is what? Minority. So the minority is called non-controlling interest, NCI. There are two ways to measure minority. So if you acquired a business worth 100 crores, you paid 80%. So what is your share? 80 crores? Proportionate. I think we are just waiting for lunch, so let's just focus. So 80 crores is your stake. What would be minority stake? 20 crores? Why 20? Some basic questions, but I'm just trying to get some attention here. Okay. So 20 crores, that is proportionate share, correct? So we said minority I have recorded at 20 crores. Normal principle. IndAs gives you another idea. It says, why do you want to record at 20 crores? You can record at a different number. Let's say minority has 1,000 shares. What is the price of those shares in the market? If it is 30 rupees, you record 30,000. Why do you want to record at proportionate value? So it's a choice. What value you record minority, it's a policy choice. Do you follow the proportionate consolidation model, that 20 crores we talked about? Or do you want to record at a 30 crores based on market pricing? That is called the fair value. Remember, if you change to fair value, what will happen? What is the implication on the accounting from an asset liability perspective, goodwill perspective? It will change, right? Because the moment you record a minority, any change to your liability, assets, minority interest, implication is directly to goodwill. The number changes. So it's policy choice. Choice made as per business combination, is made for each business combination, how you want to record. Okay, either you follow this. We talked about this measurement period adjustments, that 1 year window that you get to adjust your asset liabilities. This is that the slide talks about, that you can fine tune your goodwill only within that 1 year window. However, your valuation is still not complete within that 1 year. Sorry, you have a problem. Whatever assets sticking after that 1 year, that becomes confirmed. Any change you want to do now, straight to P&L. No adjustments to goodwill. Okay?
Only one point. This is not a free choice like that every business combination will remain open for 1 year. You as a management
have to make
a declaration that this is
provisional consideration.
We have not done fair valuation, we have not completed fair valuation, therefore it is provisional price. And which aspect of it is provisional? Only those aspects you will be allowed to change, not everything. So it is not like ek baar ho gaya, ek saal tak maza hai. It's not like that. Okay. Therefore, it's very critical to understand that if it is not final, you need to make a declaration that this is a provisional measurement, and so within that 1 year period, then you will have to make those things. And there are a lot of disclosures which is required when you do it on a provisional basis, etc. So I think exercise this choice very carefully. This typically gets exercised when you do acquisitions very close to the year end or a quarter end, where you're not able to complete the entire thing. And whenever you complete, you make a declaration as well.
So now if you, after 12 months, you discovered, oh God, there was a liability also, there was a litigation which was happening, I was not aware of it, when I did the acquisition. So can I now adjust goodwill? Sorry. It says you got enough time, you did a provisional, you said I'm doing provisional, you are searching for liabilities, everything. Now suddenly after 12 months, sorry, whatever has been discovered, if you have to pay it, straight P&L, no change to goodwill or anything of that sort. This was just a window for convenience. You took it, you declared that I'm doing this. So now, anything after 12 months, no adjustments, straight to P&L.
So is this in line with IFRS or is
Yeah,
it
it's same. No, it's the same. There's no difference. Same. Bargain.